let's talk just talk quickly about splitting. So, I mean, of course, there's the TOSI rules, the tax and split income rules that came into effect 2017, 2018, I believe, 2017.
Yeah.
And so, if you have, multiple different beneficiaries of the family trust, and, you have an operating company, so it's earning, $2 million in profit a year, and you want to distribute those funds to, say, 5 different beneficiaries, how do we ensure that we don't trigger TOSI? Because TOSI, of course, and correct me if I'm wrong, means that the recipient will be taxed at the highest marginal rate, which of course completely
it defeats the purpose, right? So,
yeah.
I mean, you can think of TOSI rules as an extension of the attribution rules almost, where if you had, what we had before is if you're trying to distribute money to a minor child, they're going to attribute that money to the adult who's in charge. So it just adds to that adult's income.
The kiddie tax.
And then, the kiddie tax, right, which is what they call that. So the TOSI rules were really to ensure that the people who are receiving money from the corporation are people who are actually involved in the corporation. So if you have a spouse who has another full-time job somewhere else, but is a shareholder in the corporation, you might want to put them on as a director, try to make them involved in the business somehow. So, and children as well, like you still have to deal with the kiddie tax, but if they're adult children, now we have to worry about the TOSI rules, where we didn't really before. So having those people have an active role in the business, having a title in the business, being a registered person on the business, like an officer or director, are ways that we can sort of get around this. But you have to look at that very carefully. It's a little tricky. So you have to make sure that you get advice on that from an accountant or a lawyer to make sure that you're not running afoul of those rules. So the income splitting rules, none of these structuring things are easy. In fact, over the last 8 years since the 2015 election, there's been a very sharp tightening of all of these different types of rules. And so planning lawyers and tax lawyers and accountants have had to become very creative in finding new ways that don't hurt what people have already planned. So a lot of these things hurt people because they planned for their retirement. When you set up a business, yes, you can choose how much you're going to pay yourself, but unlike an employee, you're on the hook for all the liability too. So while there were a lot of issues with the tax benefits of having retained earnings and using income splitting and all these mechanisms, these are the upside to taking risk. And a lot of that was unfortunately emaciated. So when you go out there and you take a risk to start a business, now you have to worry about a lot of different things, including investment of retained earnings. So money would build up in your corporation. And if you're making more than a certain amount from your investments in the corporation, that now got kicked up to a very high tax rate. And there was a huge backlash to that. And so they walked back a lot of that legislation shortly after it happened, but not all of it. So now there's kind of a limit of the amount you can make before it gets kicked up to that higher tax rate. So the whole idea here is if you're running a business, you want to have enough for your retirement, plus you want to take into account the amount of risk you're taking on. And so it's important for you to get these planning strategies in place with, tax lawyers and accountants who can help you make sure that when you retire, you're going to have the money you need to retire. And usually that's why there's a backlash to a lot of these changes.